Hi, guys. Marcel here, your strategic wealth advisor. And today we're diving into how you can actually grow your wealth by daring to be different and avoiding market trends. Joining me in the studio today is Mathieu Roy, VP of Equities and Portfolio Manager at Louisbourg Investments. Now, Louisbourg has been making some serious waves lately, picking up prestigious awards for their performance in various markets. But what I really want to dig into today is their investment philosophy. In a world where everyone seems to be chasing the same five tech stocks, Mathieu and his team are finding success by looking where others aren't. We're going to talk about their data driven approach to finding market momentum, why they aren't afraid to say no to overpriced market darlings, and what the return of normal interest rate means for your bonds and your bottom line. Whether you're a business owner looking for stability or an investor tired of the status quo, this conversation is for you. I hope you enjoy this latest episode with Mathieu Roy. All right. Well, welcome everybody. Today, I'm happy to have Matt Roy from Louisbourg Investment in the studio. Matt, how are we doing today?
Terrific. Thanks. What's
Good.
you?
Good. I did tune in to you guys' webinar. I think it's the first webinar you guys did, right? For investment markets, for your investors, etc.
In that format, yeah.
In that format?
Yeah.
Yeah,
Great.
good.
Happy to.
Yeah, I enjoyed it. It was informative. There was great visuals, and I think it was great for people to see the investment team and kind of have at least a bit of interaction with them, the opportunity to ask questions, and it was super informative. So I know it'll be great for me with my clients when they ask all the same questions that we asked you guys. So it went
Perfect.
well.
Happy to hear.
Yeah, awesome. So let's jump into, so for those of you who don't know, Louisbourg is a longtime portfolio manager with Louisbourg Investments, who's kind of the hometown heroes, I'll say, of investments here in Moncton, New Brunswick. And the reason I say that is because lately you guys have been on a little bit of a winning streak. You want to tell us a little bit about kind of the awards you guys have had in the last 2 to 3 years, I would say, and and how that all works.
Well, I think it's just outside firm recognizing the performance of some of our strategies. And, we always take the same approach. We're very fundamentally driven. We focus on our knitting in terms of picking great businesses. And there's times in the markets rewards us very well. So we're just happy to be recognized when that happens.
Right.
We focus on long-term performance, and those awards essentially reward that. And they also emphasize risk. So
Yeah,
it's the performance, but also the risk that you take in the process.
like risk-adjusted performance, pretty much.
Exactly. So we're happy to get those recognitions. It's just a testament of the effort that we put in for
Absolutely.
our clients every day.
Absolutely. And I think when you talk about risk-adjusted returns, that's kind of what most people hire an active manager to do.
Yeah.
I think, don't get me wrong, I think some portfolio managers are there to straight up outperform. That's the promise. Never been you guys' promise. You guys, it's process and discipline all the way through. And it's nice to see that, some of the most prestigious awards being handed out in Canada have made their way to you guys. Can you maybe clarify what those awards are, or at least the most recent ones for this year? Like which fund and what performance categories?
I believe the U.S. fund was, I don't remember the exact details, but was a very, very much at the top of the list in terms of top performance for long-term performance.
Yep.
And I believe our quant fund was actually the number one fund in Canada.
Yes, it was. I do believe.
For Canadian equities, it's a concentrated strategy. It's a complement to our fundamental strategy. So we use it in almost every client portfolio. So we're happy that they were able to enjoy that performance and that it's being recognized as well.
Speaking of the quant fund, I'm going to take a little deviation conversation here. Tell us a little bit about the quant fund, how it came, and quant means quantitative, right?
That's right.
Which talk to us a little bit about what a quantitative fund is and how it kind of came about and how is it set up. It's fairly simple, but I love how the simplicity has been kind of paying off and it's doing exactly what it's supposed to do.
Yeah. Well, it's there for two reasons, and we're very much bottom up fundamentals. We're buying businesses. We're looking at them from a micro perspective. But when you do that, you also there's a lot of different thematics that happen in the market at various times, and if you want to focus on quality, sometimes you have to ignore certain sectors that you deem to be lower quality
or trends
in the market.
Yep.
So the appeal is having the quant strategy. Essentially, it's quantitative factors, but it's momentum-driven factors in terms of what's working right now from a price perspective, how if the stock is working essentially over various periods of time, but also earnings momentum factors. So there's qualitative factors in terms of companies that are delivering earnings surprises, that sell-side analysts are revising their estimates up for the earnings.
Yeah.
So essentially, momentum. So there's no filter for sectors, and there's no filter for valuations
or risk or anything like that.
Exactly.
Right? Yeah.
Because we're going to use that strategy as a complement to the fundamental strategy, which is going to be a larger component of the Canadian equity exposure.
Generally, yeah.
So it doesn't matter if it's actually preferable if it's focused, right?
Yeah,
because
100%.
That's one of the reasons. It really keeps the investment management team sane, so we can still focus and really be purists in terms of what we do.
Absolutely, for sure.
And the other reason is because it works. Because the Canadian market is not as deep as the U.S.
True.
And if you backtest it over long periods of time, trends tend to last longer. So the market stays inefficient or exaggerates themes for longer periods of time.
You're right.
Currently, our quant strategy is essentially a gold and precious fund.
Ultra concentrated.
It's very constant. There's a few other names in there, but that's the focus of it. And there could be periods where the market is defensive or is difficult, and the quant fund could become a very defensive strategy for a period of time.
Sure.
Usually it's more on the aggressive, but but that's the genesis of it. The markets in Canada stay inefficient for longer periods of time, and it works. It adds value. It's quite concentrated, so it can only be a piece of your Canadian equities, but also it's perfect to keep us focused within the investment management team.
It's like it's like, I don't want to say an opposite, but it's kind of like a different measuring stick for a temperature check that you can use here and there. And correct me if I'm wrong, but 12 positions through and through all the time. So
exactly.
Despite outside momentum or other close seconds, it's the top 12, right? That's
top 12, and a third of the fund can be rebalanced every month.
Okay.
Yeah.
Okay.
So there's a rebalancing every month. We bring all the weights back to equal weight.
Okay.
But only a third of the positions can be rebalanced.
Yeah. And this fund is also called in different series the Momentum Fund, right? It has I don't want to say an alter ego, but it's the quant. So it's quantitative, qualitative factors. So it's a rules based approach, right?
Exactly.
Like you guys set the rules. Have you guys ever changed the rules over the years?
I mean, I created the strategy I think in 2011, and halfway through I tweaked. We do tweaks along the way.
Yeah.
By and large, it's still the same approach that's been used in terms of factors. The weights, we've tweaked a little bit. We've put a little more weight on certain factors versus others.
Yeah.
After doing some more back testing along the way, but it's stayed pretty similar. Yeah.
Impressive fun. So it's cool. I know clients love it. It's always from my time there, a good conversation piece with clients. And even a great complement to more traditional investment strategies. So I think advisors across the country use that fund in different portfolios and in different ways.
We certainly get a lot of inbound calls on it.
Yeah, I bet. So on that note, what do you think, or according to you, what sets Louisbourg apart from other investment firms? We're talking here maybe the big banks or the big managers, Fidelity, the CIs. How do you guys set yourself apart? How do you guys position yourself in the investment landscape to achieve success and manage your disciplined approach through and through for
Yeah.
decades now?
Yeah. Well, what I was mentioning about using the quant fund to keep us focused and sane, that's quite true. But if you look through our portfolios, you realize how true it is. And a lot of people use that verbiage in the investment world, discipline approach, focused on
Of
absolute
course.
returns. And
hmm
but when you look at what people actually buy, a lot of people are managing for their jobs. Essentially, they're afraid to be different.
Yeah.
I think about high school, and everybody has the same hair, and
Yeah.
everybody has the
Fit
same
in.
pants. Everybody wants to fit in.
Yeah.
I find that most of the investment world is, different degrees of that, and I think we're very much at the opposite end. We do not mind being different. If sometimes we'll look a little more like the benchmark or the TSX in Canada, for example. But you mentioned the banks, and I know you didn't meant it in that way. But currently, there's barely any banks in our Canadian large cap portfolio.
Yeah.
The weight is very small.
I meant their asset management divisions. Yeah.
Yes, I know you meant it that way. But
Yeah.
as an example, not a lot of managers would feel comfortable having 2% exposure to banks when it's 20% in the benchmark.
Absolutely.
And we just don't right now. We just find there's better risk reward opportunities elsewhere. We just think they're historically expensive, and there'll be times where we'll pump up our weight when the time is appropriate. But I think what sets us apart is we don't mind being that way. That's how you create long-term added value.
Active share.
Exactly. And same thing in the U.S. Like we mentioned the U.S. as being a top performing fund, really near the top of the list. And one of the best performing U.S. names the last few years has been NVIDIA.
Absolutely.
We don't own it. So
Never did?
Never did.
Okay. I remember you guys looked at it.
We looked at it,
Yeah, okay.
and we could call it a mistake or not. We don't believe that their competitive position is sustainable. So we didn't feel comfortable buying the company.
Yeah,
I guess
fit the mold.
Yeah, and we managed to outperform by buying different companies.
Yeah, sure.
So, but there's not a lot of U.S. managers that don't own that name.
It's an unpopular opinion for sure.
Exactly.
Yeah, but it goes to wanting to fit in. A lot of analysts, a lot of portfolio managers. To some degree, it's self-preservation, right?
Yeah.
Like,
no, I agree.
Not everybody wants to rock the boat. Not everybody is, even in the investment world, is outspoken. Some are very outspoken and very contrarian, and they're looking to make that one call that's going to make their career. They're going to write a book about it and whatever. We've all seen these come and go. But yeah, I love how discipline and also I would say, and I remember talking to clients, and another distinction is you guys are in I would say I don't want to say a sweet spot, but you're managing an amount of capital that doesn't necessarily force you to replicate an index. If you're managing TD Bank's dividend fund, you're going to have to own a majority of Canadian banks because there's just so much capital to be injected that you can't fill it all in all these other dividend-paying companies in the TSX. You guys don't have that problem, which gives you more of an opportunity to be different.
And that's something that not a lot of people realize, and that's true for smaller retail investors or even institutional investors. It could be people that sit on a committee that's going to decide who your investment manager is going to be for the next 5 years. They say, well, that company is larger. Isn't that better? And you use the example of the big banks that manage money. They have they have the ability to accumulate a lot of capital, and it's great business
Good
model.
business model, yeah.
But do I like that as an investor?
Yeah.
Because use that same example, TD Bank, they have say $3 billion in Canadian equities that they have to deploy. That limits their pool of investment significantly.
Yeah.
After 30 or 40 names, or the 30 or 40 largest companies in Canada, it gets really difficult for them to buy beyond that.
Yeah, for sure.
Whereas, we can select out of 300 companies.
Yeah.
And the other thing, we add a lot of value by trading those values. The markets are very moody. So that same business that I love during the year can go up and down 50%. That happens a lot.
Yeah.
And if you're medium size like we are, we're trading that. We're buying cheap, we're selling dear, the same company, sometimes, usually multiple times during the same year.
Yeah.
If you're a large asset allocator and you accumulated your position, you're kind of stuck there.
Yeah.
That's your position, and you can't trade around it.
Yeah, and I think that's important to mention, because as you've mentioned in this podcast before, and as you've made it, you guys promote this. You guys own businesses. You wanna, it's the Buffett style. I want to own the business.
Mm-hmm.
To what degree do I want to own the business? Do I want to own a huge piece of my portfolio in the business, a smaller piece, given economic landscape, valuation of the business? You guys assess that and trade around that to your investors' benefit. But to what you were saying, as someone who's trading it and making these trimming decisions, let's say, well, it's a different, moving a 1% position in a $100 billion fund is different than trading a 1% position in,
$200 million.
A $200 million account. Way different.
Yeah. No, exactly.
Let's change gears. Let's talk a little bit about the broader economic and investment landscape. So can you maybe talk to us a little bit about, last time we talked was a year ago, so can we go a little bit through 2025, what has happened, and kind of what's changed where we are at now? Obviously there's been a lot, but I'm just kind of high level out of the economic, macro scenario.
Yeah. The markets are deep and complicated, but if you try to narrow it down, when you're buying equities, you're essentially buying companies' profits.
Yes.
And when investors feel confident that those profits are going up, they're more willing to pay up for those profits today. Yeah. And essentially that's what, there's a ton of different things that are happening in the market, but that's essentially what's happening when you're thinking about equity markets.
Yeah, it's that's the demand currently, right?
Exactly. So there's certainly you want commerce to flow, to have more business activity, to have those profits go up. The other thing that helps those profits is low interest rates.
Yeah, absolutely. That's
because
huge.
you can borrow to invest. It just stimulates economic activity.
And it also affects the valuations, like the formulas you guys use to calculate what a company should be worth. You plug in current interest rates.
Exactly, right? Yeah. So if you dial back and you look back at early 2025, where Trump was at his had his peak in terms of tariffs and trying to change the rules of trade,
pretty much,
on a global basis, that was concerning because that could add a lot of friction to the market. And at that time, we're still coming off a period where inflation was high but cooling off. So you're adding trade to the mix. You're creating concern where are you going to slow down economic activity by slowing down commerce, but also will you spark inflation, and then you have to bring rates up, which again slows down the economy.
Chokes out,
So that's a concern in terms of to invest, and that was in early 2025. It's some of that is still there. But at the same time, you have this AI revolution happening, which is helping companies become more efficient quickly.
Yeah, scaling for sure.
And so that's taking a lot of pressure off inflation. So it's tough to say. So inflation has cooled down.
Yeah, it is. Surprisingly, more than I had thought when I saw the chart.
And it's really tough to pinpoint, but I think a fair bit of that is that.
From the production output.
Yeah. And there's other things. So maybe immigration also slowing down, puts less pressure on housing.
Yeah.
So there's a lot of factors.
Rates have come down a bit too, and
Yeah. So you still have those, you have wars, you have those more tensions between countries. That's negative. Although, it's creating perhaps onshoring and people building things in their countries to protect themselves. So that's the backdrop. There's some puts and takes there, but the one of the drivers of the economy that makes us maybe a little more optimistic is inflation has cooled down. You have AI helping to cool down, but it's also having a positive impact in terms of stimulating economic activity right now.
Right.
There's businesses that we invest in. I like to use that Badger example. It's a $1.5 billion business. That's the market value of the company. And they do hydrovac. So essentially it replaces digging.
Oh, yeah. I know what that is.
With backhoes. And they do a lot of business for utilities, for the construction sector. And so it's not a small business. I think they have 1,500 units in North America, mostly in the U.S., 90% U.S. now, started in Canada. Yeah. And about a year and a half ago, 0% of their business was to build data centers, and now it's 8%. It doesn't sound like a big number, but going from that's still a lot of business in a very short period of time. So you can see the impact it's having right now in terms of investments, building. It's supporting a lot of North American activity. Yeah. And there's also the promise of making businesses more efficient. So those are the puts and takes of the market. It's you're getting a kind of a tougher adversarial environment between countries, and there's puts and takes there. It slows down commerce, but you build other avenues. But the AI boom is
it's real.
It's real. It's significant. And then how long does the build out last? Yeah, difficult to say, but it's important.
Yeah, totally. That makes a lot of sense. And when you think about it, AI, we all, use ChatGPT in our own lives. Most people are using it in a very small way. It's impacting our lives in a very big way, but we're using it in a very small way relative to what can be done, automations. And when you think of the increased production capacity, because when you buy a business, when you mentioned that, the valuation, you buy the business at the price today based on what kind of earning stream, what kind of piece of my piece of the company's earnings, what am I willing to pay to get that? While as a company gets more efficient with AI adoption, et cetera, all of a sudden it, to your point, makes it a little bit more attractive. If you think AI is going to help that company or help all companies, eventually they're all going to make their way. And then I'm definitely sure that notion that AI is going to bring capacity up and keep costs relatively stable, that's more earnings in the company's pocket, more earnings in your pocket. So I can imagine that definitely is floating and supporting valuations in the markets at this point.
Yep, and probably more to come, but you're seeing benefits already across a lot of companies, and it's a massive focus by investors asking those public companies, and a big focus from their boards and management teams in terms of what they're working on. Yeah. One example I like to use is Stantec, which is we've owned Stantec for the last 20 years in our large cap Canadian equity portfolio. Great business, created a lot of value. Essentially, engineering consulting. Yes. They've been consolidating that market, and it's still very fragmented throughout the world. But they said that, and I might be getting that wrong, but usually when they're quoting, there's a project and they're responding to an RFP. Yeah. It takes weeks to answer, right? So they have to go through their previous RFP, similar work they've done in the past. A lot of junior people are involved in putting that together. Yeah. Now it's, it goes from weeks to a few days, maybe hours, and essentially, AI is scraping their own databases of information quickly and producing that RFP custom to the type of work. Could be water in a certain area, and they have the documents to
guide the AI. So they can create a custom GPT or whatever,
Exactly.
custom with only their information. Because that's what I found to be the most annoying thing with AI. If you're kind of using it, I'm using it quite a bit. It makes a lot of mistakes.
Hmm.
If its source is the internet,
Yeah.
it makes a lot of mistakes. Even it makes a lot of mistakes for me even within spreadsheets. I'm like, where'd you get that number? Like that number's not even there.
Yeah.
But when you give it a set
Hmm.
of instructions, guardrails, like in the case of Santec, it's pretty impressive because it does its job really, really well. Like
Yeah.
faster and arguably better than a human can. Yeah.
Yeah. No, it's impressive.
Yeah. Okay, well, let's talk a little bit about like we talked interest rates. Can we talk a little bit about the bond market, fixed income, how they've behaved and performed in the last little bit, and maybe how we expect they'll go moving forward?
Yeah. I mean, I'm at the core an equity guy.
For sure.
I do manage the preferred shares, which is technically on the fixed income side,
Yeah.
and they've been performing well for
Mm-hmm.
an extended period of time. And actually, the point I'll make on fixed income and bonds, in 2016, we created the preferred share fund in part because yields, like interest rates, were so low
Yeah.
that you're saying, well, I can't have our clients only in equities. They need, but
They need something.
the bond asset class is positioned or is set up that it's not going to deliver
Yeah.
significant returns because they're offering you a coupon of 1.
Yeah. Yeah.
So you're taking interest rate risk without the interest rate reward.
Totally.
And I mean, we could have gone negative in terms of interest rates like Europe. So
Yeah.
you can temporarily have some profits with bonds, but if you buy them to hold them, it didn't make
Yeah. Yeah.
a lot of sense. So we essentially created the preferred share fund to enhance the yield and provide
Yeah.
reasonable returns for that asset class during that period. So today, fast forward to today, preferred shares have done well, and we still like them, but they should offer more reasonable returns on a go-forward basis. But now you look at the bond market, it's a normal, reasonable bond market.
Yeah.
So the curve is upward sloping, meaning that interest rates today are lower, like for short periods of time.
Yeah.
But if you're willing to lend for 10 years and 15 years and 20 years, you lend at higher interest rates.
Yeah. Just like it should be.
As it should be. That's a normal market. And if you hold to maturity, you should get mid-single digit returns for the asset class. So I think the bond market is reasonably attractive here, especially with
healthy for sure.
with inflation rates coming down. That's your risk too. If you buy bonds over long periods of time and inflation kind of moves away, you're destroying your purchasing power.
Your real returns, yeah.
But with inflation coming down with AI and rates at pretty reasonable levels, we feel that it should do its job in the portfolio.
Right, at the very least. Yeah. Mid single digits. I mean, that's what a bond's for. It's to kind of smooth out the highs and lows of the stock market sometimes for a balanced investor, bring stability and income. And I think, when I saw the yield curve being like as normal as it almost can be, I don't know,
Normal
no pro
steep.
either. Normal steep. I was like, all right, well, that's a good thing. That's a good sign.
Yeah. And I mean, people get really focused in terms of the Fed's going to cut or not. Really, the bond market, I think, has it right. I mean, there might be a few other cuts in there, but the 10-year and the 15-year, the 20-year interest rate is not overly affected by that. It's more going to have to do with the economy and inflation. And so I think you get a healthy bond market right here.
Yeah, the bond market rarely gets it wrong because it's pretty much straight math. There's a lot less speculation when you're evaluating the bonds, particularly over equities. Equities get emotions are involved, right? All right, well then moving ahead to equities, maybe we can talk a little bit about how equities have performed, and mainly let's say North America, U.S., Canada. I know you're focused on Canada. But let's talk about equities and how they've behaved lately and where we hope how are they positioned now.
Yeah, I mean, equities have been we had 2022 where everything went down,
Yep.
bonds and all risk asset classes. But aside from that, you look at the calendar years, they've all been pretty strong. 2020, 21, skip 22, 3,
Yeah.
4, 5.
Yeah.
So
Strong.
we've had strong returns. You look at the valuations today. U.S. is a little more expensive. Canadian and international equities are trading at normal levels. So you have those risks that we talked about earlier that could disrupt the market.
Yep.
But you also have some positive, what could go right. Then you're seeing it with AI, boosting the economy and boosting corporate profitability. Market corrections will happen. Does one happen in 2026 or is it in 2029? It's really difficult to say those things.
Sure.
So, but I think we have a healthy backdrop of a market. In terms of which ones will perform the best, the 2000 to 2010 decade, was really Canadian equities.
Yeah.
Resources performed really well. China was building. And then you had a long period of U.S. leading with the big tech companies.
Yep.
2025 was everybody did well, but Canada did better because you had a big boost with gold and precious. So helping commodities. Is that the beginning of a new trend? Certainly those companies are a lot more profitable today. They are dependent on a price that is very difficult to predict, and it's really not based on a whole lot in terms of the long term. And on the U.S. side, those tech companies are doing attractive things, but they are also spending a whole lot more than they have in the past.
Right.
You're looking at those CapEx budgets, like, I forget the exact numbers, but I think Alphabet was out 2 days ago, and they're going to spend $200 billion in 2026.
In AI and infrastructure.
Wow.
That's a big number.
So the market will want to see some return. I mean, they're growing fast, but they're now spending a lot, where they used to be businesses that didn't need a lot of CapEx, right? Because it was tech focused. So but now because they're building those data centers, they need CapEx. So the markets will want to see returns. So it's really just going to be a choice in terms of does the market want to be more resource focused versus tech focused. So we've seen a bit of a shift recently where resources have caught a bid, and Canada essentially will lead if that continues to be the pace. The theme.
Yeah.
But the ingredients are in place for good results, but there are also risks. Corporate spreads are pretty tight, so there is risk seeking in the market
for sure.
So something could break, but the fact that inflation is low means that it's unlikely to be interest rates that cause that break. And certainly Trump is trying to break things, and
he's definitely not putting any oil in the machine.
No.
That's for sure. And international equities, I think they've been kind of, I don't want to say rebound is the right word, but they've also been performing quite well recently as well.
Yep. Which is interesting because it's the financial sector is large in European banks essentially,
like banking,
and they haven't been, like, European banks historically have been very poor performers.
Okay.
Whereas Canadian banks have been pretty strong, and maybe U.S. in the middle. So things have gotten better for them. Conditions have gotten better. So they've really rebounded hard from a low point.
Yeah.
So some of the performance has come from there, but we're still seeing a lot of inexpensive companies in other sectors. We wouldn't be too interested in chasing those European banks, but in other sectors, the industrial sectors and healthcare sector in Europe, it's quite attractive.
Yeah, it's good companies everywhere.
Exactly.
Yeah. All right. So one question I've been getting from friends, clients, and one that I've been wondering as well, looking at some economic charts and some data, is that we seem to be in a relatively long economic cycle without, and I'm going to choose my words carefully, any meaningful extended downturn. So obviously, pandemic excluded 2022. Again, I called that more of a flash in the pan. The pandemic, real panic, but also I wouldn't say an overly extended downturn. So if we kind of exclude those two, we've been in a very long economic cycle. My guess is by economic stimulus, the governments are getting better at money. Let's call it money management, interest rate management, money supply management. Do you have any comments on those concerns where, like, from what you're saying, it sounds like the structure's there. The market seems sound. The ingredients are there for a healthy market going forward. Outside of a black swan event, we feel cautiously optimistic. To the pessimists, do you have anything to say on that side?
Yeah, maybe I painted too much of a rosy picture.
Well,
I guess my point
yeah,
is, if you look historically, it pays to be bullish.
yeah, over time.
People are always concerned, afraid to be there if there's going to be a correction. But if you look at the calendar year returns,
Yeah,
last 50 years, whether you look at the U.S. or Canada, it's mostly green.
yeah,
And you're going to get, so it's always, I guess what I'm advising is saying, don't try to position yourself too much for correction, because it's really difficult to
yeah.
predict when it's going to happen. And early 2025, I thought we are going to stay in kind of correction mode and difficult period
Yeah,
for
bear
longer.
market. Yeah,
It didn't look like we were going to snap out of fighting in between countries.
yeah,
But maybe it's AI, maybe it's internal building within countries that's creating economic activity, but essentially we've offset that.
yeah,
In terms of, it feels like government intervention is happening more aggressively when things start to go wrong.
yeah.
So perhaps that's why we're not getting prolonged downturns.
Difficulties. Yeah,
But I think, I mentioned it earlier, if there's not a lot of inflation in the system, it's a lot easier to deal with.
yeah,
And I think that again, maybe it's AI, but inflation is cooling off. If you're able to have lower interest rates, you're going to be able to
yeah,
stimulate the economy. So there's risks out there, and
for sure.
I said I'm a bottom up manager, meaning that in Canada, in the U.S., international, I'm always finding attractive businesses.
Yeah, to own.
Yeah. So it's difficult to be too bearish.
Yeah,
And if you talk to those businesses, things are going well. Like if you talk to a lot of consumer businesses, industrial businesses, their end markets feel good. Like
right.
It's not slowing down.
Yeah,
So we're finding plenty of opportunities, but at the same time, for your bearish friends, I get it. Like, you have the largest economy in the world, essentially picking fights everywhere.
Yeah,
And you could easily break something, and that's happening at a time where it's I don't think stocks are necessarily expensive.
Yeah,
In aggregate, there's plenty of interesting businesses at reasonable prices. But if you look at the bond market, it's in risk-seeking mode. So if you break something when spreads are very tight, you could have a decent correction for risk assets in general. So I'm not trying to be overly bullish or bearish.
No,
I think but I think I have to say that me versus 6 or 8 months ago, I'm probably a little more encouraged because I'm less worried about inflation.
yeah. And the governments, to your point, the interest rates are at a relatively healthy point, meaning if they do need to lower, they can. Like they can. They're in a little bit of a sweet spot where they have wiggle room on either way, and they've been quick to intervene, and that's it's kind of been thematic in the last decade or so. So yeah, I agree that if you look at a square of all the calendar years of performance, there's a lot of more green squares than red squares. And, I always tell clients it's kind of like, you could, for a longer term investor, 20 plus years for sure, you could put your entire investable capital at
Hmm.
the top of the one of the worst corrections in history, and you still made a
Hmm.
really good rate of return, even if you timed it worse.
Yeah.
And there's always strategies to mitigate risk, dollar cost averaging, and stuff like that, which goes a long way. And but yeah, I agree with you. Having your focus, a bullish attitude, focused on the long term, is the way to go. And yeah, when you're looking at green versus red squares and the percentage of which ones are up years versus down years, it's kind of like a roulette. And if you knew 75% of the roulette wheel was red,
Hmm.
you'd be buying red, or black, I guess, in this case.
Hmm.
If you knew 75% of the roulette table was black, you'd be betting black all the time. So I'm going to bet that the markets, generally go up most years. You just have to tolerate the down years.
Exactly.
Yeah. Okay, Matt. Well, thank you very much for your time. This was awesome. Looking forward to sharing with people, and appreciate your time, man.
Always fun.
All right,
Thank you.
cheers. Bye. This information is from OnVisor Inc. It is intended for general knowledge only, not professional advice on legal, tax, accounting, investments, or personal finances. All figures or data are believed accurate at the time of publication. Consult a qualified professional for personalized guidance and planning. Louisbourg U.S. Equity Fund named 2025 GMR top performer, top 3% of peer group, first quartile performance for 1, 2, 3, 4, and 5-year periods. Source: RBC Investor Services Survey as at September 30th, 2025. Louisbourg Quantitative Canadian Equity Fund ranked number 1 Canadian equity strategy for performance over a 10-year period. Source: RBC Investor Services Survey as at September 30th, 2025.